Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the EIA show, we're going to look at, as we normally do, break it into our three segments. And we want to look at it from the perspective of, okay, well, crude and gasoline built, what does that really mean? Are we normal? What's the rate of change? Because remember, gasoline is typically drawing at this point in time, and crude is normally doing the same. So we want to look at how is that shifting, while on the other side, distillate is normally building, and yet that drew. So we're getting that disconnect in terms of what's going to happen when we get into winter, and where is that shortfall? And again, it continues to be weighted towards PADD 1, which is again that East Coast. So demand struggles continue. We don't see that changing, as we've been saying that there's going to continue to be that problem in terms of where's gasoline demand, where's distillate demand, and again, this is looking at the U.S. And then in the last segment, we want to talk more about gasoline, because gasoline builds. Storage has gone through the roof. You have Singapore at a record. Europe is going to be at a record by the end of this week. So we continue to see this becoming a bigger problem. And what does that mean for refinery runs? Are we going to see economic run cuts? If we do, when are we going to see them? And is it going to happen at really the worst time, when we should be seeing more distillate being put into storage for winter consumption? So those are things that we're going to talk about today. So getting right into it with what we're seeing, obviously OPEC, we started to get some commentary from the JMMC in terms of what is the recommendation. So right now they're saying that they should increase production by 100,000 barrels. And I think this is a good chart in terms of highlighting, where is the original baseline? So essentially you're coming right back to where we were prior to the OPEC plus agreement. But then the actual cut has obviously been bigger. And we've been talking about, well, what is driving that? And when you look at who is the reason for that reduction, it's important to look at who is falling short. So when you look at the drivers of it, it's West Africa and Russia. So Russia obviously has the issues that we all know of in terms of sanctions, in terms of pipeline flows versus what can be exported. But it's really the West African front. And obviously you see Malaysia's down, but a lot of that Malaysian was really Iranian. So there's a certain amount that is a bit of a wash there. But Nigeria and Angola, even at the reduced levels, and we've been saying this from the beginning, and we'll have the chart in segment 3, floating storage continues to be at all-time highs because they're struggling to sell their volumes. Now, Angola was able to sell a decent, at a normal clip last month, but now it's starting to slow down a bit, just because, again, China is not buying to the same degree that they have in the past, which is creating some of those additional shortfalls. And these are some of the key pieces, because Saudi Arabia and UAE have the spare capacity to meet it. But we aren't really going to get back to that normal level, because at this point there's no reason or impetus really for Nigeria or Angola to try to increase production, because they can't sell, or at least they're struggling to sell, these reduced levels. The other big issue that we continue to see is the type of oil in the market. So as we said, obviously there's a distillate shortage, but there's a lot of gasoline. And the only way to really adjust that in any meaningful way, because again, raw, just basic numbers, for every 1 barrel of diesel you make 2 barrels of gasoline. But if you want to increase the distillate yield, you need a heavier barrel. And typically, like U.S. crudes and the lighter crudes don't really have a very high distillate cut. And the crudes that do have a high distillate cut, just there's just not as many of them, and they're at a bigger shortfall, which is again also creating some of this disconnect on the premium front. So now when we look at just what is happening around the world, here you can see total oil and product stocks. This was, remember, 2 weeks ago, came down a bit. You're still within the lower end of the cloud. But as we've been saying, nothing goes up in a straight line. So it's just the trend continues to be up as we continue to see gasoline, the biggest driver of this, and crude storage starting to creep a bit higher. So we will continue to see that moving up. Crude stocks, land and floating, fairly flat. We're right back to where we were in comparison to the average from 2017 to 2019, with a mixture of that being on the onshore and offshore. So the deficit widened for total oil and product stocks from 64.5 to 78. Land and floating on the crude side from 9.5 to 21.4. And then total oil product stockpiles, the deficit widened from 55 to 56.6. Again, the driver of that, distillate continues to be the bullish side, while gasoline continues to be the overhang. Now, when we look at the land storage, you can see that we're coming right back into the lower end of that cloud. And as we've been saying, as the comps get easier, and I had a good question, and I apologize for not describing it better in the show, but a question on the in the comment section was, what does that mean, comps get easier? And when you look at previous years, there's typically a draw. So as the months progress and we just go sideways, well, essentially the seasonal component gets better because we get this drop down in terms of where things are. And that's when you get this convergence, which we're seeing in land storage total against 2021. The deficit widened from 48 to 56.1, but you can see that 2021, 2015 to 2019, you averaged on those draws, which is where we're creeping into with west of Suez. The deficit widened from 30.9 to 34.8, but you can see we're now back in the bottom of the cloud. And when you look at that dark gray line and the pink line, we're running right into that, which is what we've been discussing, where those comps come down. And as we continue to go sideways, that's where we're going to really fall right back into normal. Now, east of Suez, the deficit widened from 20.4 to 23.3. That's something that is going to essentially kind of stay flattish when you look at east of Suez. Now, China drew down its crude stockpiles last month. When you look at what it went from 1.05 billion barrels to 1.02 billion barrels. So still starting to get some of that movement, with a large part of that being driven by Shandong, which is really the only refining assets that have been operating at really above normal levels, with the SOEs and the large entities still operating a bit on the reduced rate. So now when we pivot over to floating, here you can see that floating storage, the deficit widened from 15.4 to 24.8. And this is important when you're looking at where typically you come into floating storage, the floating then sits there and then converts into land storage. So again, this is why you will see that bounce back. You will see that recovery, especially as the U.S. continues to start to import some of this, because we did get a big spike in floating storage in the U.S., which typically converts over the next, usually 7 to 14 days into the amount of floating into land storage. So when we look at west of Suez, we flipped into surplus from negative 3.3 to positive 1.5. East of Suez, essentially staying fairly flat, with the surplus widening from 21.2 to 23.9. So you can see, again, we're moving in that direction. But as we've said before, on the floating storage side, on a lot of these, we just don't see too much movement up or down. So India, one of the biggest exporters of diesel in Asia, halved levies to boost shipments after the trade gap swelled to a record last month. Government on Tuesday cut export taxes on diesel to 5 rupees a liter from 11. So we're starting to get some of those shifts, which will, again, support some of those exports from India. So when we look at crude stocks here, you can see a build of 4.47 million barrels. It's still 49.5 million below the 5-year average. But again, that is all driven by PADD 2 and Cushing, with PADD 2 down 22 million below the 5-year and Cushing down 18.3. But when you look at the build, so there was a build of 4.47 million, and all of that was actually driven by PADD 2, which was up 3.46, and PADD 5, which was up 2.49 million. PADD 3 had a small draw of 1.66, but that disconnect really between imports slowing and imports still fairly flat, while exports, even though exports came down, they're still very elevated for where we are this time of year. And that's where we're going to continue to see that spread, especially given the discount that the U.S. crude is holding versus the previous. So now when we look at the crude oil production, again, not much change, and we just expect that 12.2 million to come across. And then when you look at the SPR, once you factor that in, had a small draw of 212,000 barrels. So that's what we have going forward. And when you look at where are things going, where are things heading, that's when we start looking at runs. So runs got cut again on the refining space. They were down 1.2%, from 92.2 to 91. And all of that was really driven by PADD 3 through 4 and 5, with PADD 3 being the lion's share. Still above the 5-year, but PADD 5 is the one that continues to be at the reduced rate, which is the biggest, one of the biggest things that's really impacting where runs are right now. We're still in a seasonally normal spot. This is a bit low, so we do expect this to bounce, but not a huge bounce, just staying within this 92% range as we continue through the remainder of this month. Now, when you look at the refinery run rates, this is what we've been talking about in terms of where we are. This is looking at the last 10 years. So we're still within that gap. We're a bit below the average, but again, there's nothing too crazy in terms of where some of these movements are and how they've been moving through the running the asset. But again, when you look at run rates, as a percentage, they come down, but as an actual throughput, it's come down even further because we've had facilities come off. So even though they're at 91%, it's not the same type of throughput that we would have had even last year when you're looking at that percentage on a volumetric basis. Imports were up 1.178 million a day. That it's really driven across the board. There was an increase in imports in PADD 1, 2, 3, and 5. With the biggest being in 1, 3, and 5. PADD 1 had an increase of 349,000 barrels a day. PADD 3 smaller, getting to where we were saying they were going to get to, closer to about 1.65, with an increase of 149,000 barrels a day. But PADD 5 maintaining its lumpiness, big increase of 643,000 barrels a day. Now, again, it's gonna bounce around. There's a lot of crude waiting to be imported now, and a lot is obviously relative because it's still below the 5-year average in terms of what's going to come off the water and into storage in PADD 3. So now when you look at crude oil imports, as we've been saying, we expect it to get higher, to see that peak. We're not getting back to the 5-year, but again, you're going to see that trend moving back up as the imports come in, again, trying to make more of a distillate cut versus the gasoline cut. PADD 2 had a small bounce. We expect it to continue to move higher as we see more of that PADD 2 crude coming in, as, again, they just come down from Canada. So we do expect this to remain above the 5-year average, but not making new all-time highs, just staying within the cloud, just above that 5-year. Implied demand, as we actually had a bigger decline than what we were expecting in gasoline. We were expecting to come closer to about 9 million barrels a day. Instead, it dropped 704,000 barrels a day, down from 9.2 to 8.5. That's sizable. There's going to be a bounce off of that. That's something where we think it's going to get much closer to about 9 million as we go into next week. Diesel, small bounce of 127,000 barrels. This is the range we see it staying in, that 3.7 to 3.9, 3.7 being the low end, 3.9 being the higher end, and coming in at about 3.877. So you're getting to that level. Jet had that drop that we've been talking about it came in at 1.44 million barrels a day. Remember, our spread is 1.45 to 1.55. So again, right within that level, and we'll bounce back and forth in there, with propane having a nice increase of 119,000 barrels a day, just bringing us back right around the 5-year. But again, exports continue to be the biggest driver when we're looking at propane. Gasoline demand is, based on this, is actually below where we were in 2020. Again, there is an overreaction to the downside. There's timing in this. There's a lot of different pieces. So it's always lumpy, which is why we talk so much about the average, which we cover at the first slide of segment 2. but you're getting an idea that just demand isn't where it was. And this is even as prices have come down, and even as prices have come down, we're just not getting this big movement just because, again, people are concerned about a lot of things. Obviously, the gasoline price is important, but there's other pieces of the economic overhang that continues to sit within. With crude oil inventories, again, trending higher, and crude oil is actually now at the highest level it's been in 2022. Again, this doesn't include the SPR. Remember, there's going to be not all of the stuff being sold from the SPR is sold for good. Some of it is what you can call as rented, where you have to deliver oil back plus interest, with the interest being in additional crude barrels. So again, this is something where when we look at this, it's important to just look at where we are. And as we've been saying, it's just, again, grinding higher. It's just we're here. But when you look at 2018 and 2020, you can see that there's that drop down, which is why when you look at just the average, because let's call it from May, from really the end of May till the beginning of September, you have a drawdown in crude, and we're just saying that we're going to shake that off. We're going to go sideways in crude, and so those comps get easier because the storage in previous years on historics comes down, and things start to look a bit more balanced. So then when you look at supply of crude, again, there's nothing to speak about, just continues to go sideways, which we expect, while oil storage and products continuing to drift up. But it's important to appreciate this is being driven by gasoline and crude, not distillate. Distillate continues to be in a very bullish backdrop. And right now, we continue to trend along that white line, which is the 2017-2018 line. Gasoline storage, again, seasonally speaking, we had a small build of 160,000 barrels a day. But when you look at previous years, there's typically a very sizable drop from really the July 4th all the way through the end of September. And here we continue to say that it's just going to go sideways, and we're actually going to run right into those drops, just because we don't see demand picking up. While refiners tried to create diesel, they're going to continue to throw off gasoline, and without any real demand, it's going to just go into storage. But we still have summer demand, so it's still going to be above what it is during the shoulder season, which is why we're just not going to have draws or builds. We're just going to go sideways, or at least it's going to average out. We might have a small build like we did today. We'll have a small draw, and the small draw could be 1-2 million, small build, 1 million, 2 million. Again, we're just going to average and just bounce along as we get into the end of the summer, and you're going to see we're going to run right into where those other years are. So even if you look at it against the 5-year, which is, again, just a metric, it's even though we're 8.9 million below the 5-year average, that is collapsing quickly, as the other historics, the previous years, normally have draws. We don't get those draws, and we run right into it. So then when you look at the distillate side, that's where we have those counter seasonal draws, where we should be building. So we're not even getting a slower rate of change. We're actually drawing with draws of 2.4 million. And again, this is going to be a big problem. Most of this, if not all of it, is being driven by PADD 1, and that is going to be a huge problem because there's no easy way to rectify that given the shortfalls that persist. Jet fuel storage is back to 2022 highs, pretty much in line with the 5-year. Not too much to say one way or the other. Now, when we look at the crude curve, you can see that when on the crude curve side, things have stabilized. You see the front month continues to weaken, but the curve continues to hold in. And that's what we've been talking about the most is, and this also speaks to the lack of CapEx. When you're looking out, there's that support, which is why, even though obviously the front month we've been concerned about, we haven't really made a just because of the volatility. If you want to short it, great. If you don't, that's fine too. But we do think the belly of the curve continues to be an area of support. Then when you look at crude oil inventories, PADD 3 tracking right at 2021 levels. So again, nothing too crazy to look at, because when you take away 2020, which is obviously that yellow massive year, we're very much normal in PADD 3. So there's really not much to say one way or the other when we're looking at the Gulf Coast. Storage at Cushing, as we were saying, it's going to drift higher. It's not going to happen in a fast way, or we had a build of 930,000 barrels. It's still 18 million below the 5-year, but it's going to just waffle back and forth. We don't see a massive build. We don't see massive draws. We just, again, kind of see it in this level, especially as the Gulf Coast matters a bit more. Floating storage had the big spike. This is some of those barrels that we discussed where U.S. refiners are trying to take advantage of some of the discounted crudes coming out of West Africa and the Middle East, and here they are showing up. Now that's going to start to come through, and that will, again, support builds, especially in PADD 3. So even as imports remain elevated, we're going to export the light sweet, import the medium sweet, heavy sours, and that's going to be that balancing act. So again, coming to the full circle to what we've been saying, we don't expect much from crude storage, just the sideways backdrop. But in theory, that actually gets more bearish as we progress, because it just shows that the shortfalls aren't as steep, and as we run into some of these metrics that others use and that we've talked about on the 5-year. So that's what we have for you here. In the next segment, we're going to go deeper into U.S. demand and how that is progressing.